The International Monetary Fund has raised alarm bells. The risks to financial stability have increased, and IMF chief Kristalina Georgieva emphasized that 2023 is going to be another challenging year, and global growth is predicted to slow to below 3%. And even if things improve in 2024, the overall outlook is still weak. In fact, global growth will remain well below its historic average of 3.8%. This news was delivered at the China Development Forum, and we can't stress enough the importance of paying attention to what Georgieva is saying. In today's video, we are going to explore the causes behind the projected lower growth, its impacts on various regions, and the possible future outlook. But first, stay up to date on the latest economic insights and analysis by subscribing to our channel. Join our community of savvy investors and business enthusiasts who never miss a beat in the ever-changing world of finance. Growth rates. The buzzword you can't escape. They're pretty important when it comes to measuring the performance of something over time. Let me break it down for you in layman's terms. Basically, growth rates show us how much something is changing each year as a percentage. If the growth rate is positive, it means that the thing we're measuring is increasing over time. If it's negative, it means it's decreasing. So growth rates can be used to assess how well an economy is doing or to predict how well it might do in the future. But why are growth rates so important? Well, let's take a look at history for a moment. Remember the Great Depression? One of the biggest reasons it was so devastating was that the economy was in a state of negative growth for several years. That means that the economy was shrinking and things were getting worse instead of better. On the other hand, we saw a positive growth rate before the 2008 financial crisis, which actually contributed to the crisis. Banks were loaning out too much money, and people were taking on too much debt because they thought the good times would keep on rolling. So you see, growth rates are a big deal. And now that you have a better understanding of growth rates, you'll be able to understand what's coming next. We have been told for years that everything is fine and that we are not headed for a recession, but it is starting to look like it might not be the case after all. In fact, things may be worse than we thought. According to IMF chief Kristalina Georgieva, global growth in 2022 has nearly halved since the initial return of COVID in 2021. That's a huge increase, from 6.1% to 3.4%. Yikes. And it doesn't look the best from here. There are many factors contributing to this slowdown, including higher commodity prices, rising borrowing costs, and rising geopolitical tensions. The conflict in Ukraine is still ongoing, creating major supply chain issues that are impacting the global economy. And let's not forget the lingering post-pandemic blues, as well as trade wars and sanctions imposed by global heavyweights like the US, as well as China's introduction. All of this adds up to a very bleak outlook for global growth. Georgieva predicts that growth will fall below 3% by 2023 and remain weak for years to come. So buckle up, folks. We're in for a bumpy ride. So, what does this all mean for different regions around the world? Let's take a closer look at how the global economic slowdown could impact areas like the US, Europe, and the developing world. The current state of the U.S. economic situation is uncertain and worrying. With more than half of last quarter's growth attributed to corporate inventory returns, the bottom line is in question. Most economists agree that growth is slowing sharply, largely due to the Federal Reserve's efforts to curb inflation by raising interest rates. However, these higher borrowing costs have had a significant impact on the construction industry, making it more difficult for Americans to buy homes and invest in large purchases. Layoffs are also on the rise and food prices are up. The collapse of Silicon Valley Bank and Signature Bank, two of the biggest bank failures in the U.S., have historically also contributed to the recession. Banks are likely to impose tighter conditions on loans to save money in response to active withdrawals from jittery depositors, which will further slow economic growth. Under such circumstances and the news of a lower growth rate by the IMF, Americans might face a troubling year. Just as the United States might grapple with the impacts of a lower growth rate, Europe could also face its own set of economic challenges. But we would again like to remind you to subscribe to our channel to support our work. Things don't look too great for Europe in the near future. The ongoing war in Ukraine, high inflation, and strict monetary policies are all going to drag down the economy this year. The United Nations World Economic Situation and Prospects Report for 2023 paints a pretty bleak picture. While things might get better in 2024, with growth expected to reach 2.7%, it all depends on how quickly the monetary policies change and what happens in Ukraine. All of this bad news is going to hit Europe's job market hard, especially in countries that have already been hit hard by the war, like Poland and Eastern Europe. Credit Suisse, a major European bank, has already been in crisis mode, and France is also facing more turmoil with protests over pension reforms. It's not looking good, folks. Impact of this lower growth rate is going to be brutal on the developing world as well. A lot of these countries already have crazy high debts, and this is only going to make things worse. Pakistan is already in a bad way, and this could push it over the edge. And let's not forget about the African countries that are going to get hit hard too. While China and India might have some momentum going, the low-income countries are going to be struggling with higher borrowing costs and less demand for their exports. This is going to cause poverty levels to skyrocket in these regions. It's not going to be pretty. While the impacts of a lower growth rate will be felt globally, there are potential solutions and recommendations to address these issues and improve economic growth in the future. The IMF is recommending that governments step up their game and make some policy changes to boost economic growth. They're also urging for a global safety net to protect people in developing countries, especially since poverty levels are expected to go up in places like Pakistan and Africa. And let's not forget about working together to tackle the war in Ukraine and ensure our supply chains are strong. The IMF chief says we should use higher interest rates to tackle inflation and support struggling banks. But don't worry, they're keeping an eye on the dangers in the global banking industry and taking action to avoid financial pressures. Apart from that, leaders in Europe, especially in France and Germany, must devise policies that are people-friendly. Macron needs to understand that he needs to do away with his proposed reforms to go with the will of the majority. In a nutshell, the IMF has released its latest prediction for 2023, and unfortunately, it's not great news. The global growth rate is expected to be lower at around 3% due to the ongoing war in Ukraine, the COVID-19 pandemic, and other factors. But don't despair. This is a call for collaboration and collective action. It's time for all of us to come together and work towards solutions that will promote economic stability and growth. In the words of the IMF chief, Kristalina Georgieva, now is not the time for complacency. Let's roll up our sleeves and get to work to build a brighter future for the global economy. If you like our content, do subscribe to the channel for more updates. And do let me know your thoughts on this crisis in the comments section. We catch you at the next one. Bye.